Good afternoon, everyone, and thank you for joining the first in a series of 3 webinars where we'll be exploring our exit options for business owners. Today's webinar will be covering the trade sale process. In a couple of weeks' time, we'll be looking at management buyouts and employee ownership trusts. And in 4 weeks' time, we'll be looking at selling to private equity. My name's Matt Wilmot. I'm a director in the corporate finance team here at PKF Francis Clark, specialising in company sales, acquisitions, management buyouts, and employee ownership trusts. I'll be the host of today's panel discussion, supported by my panel of experts and colleagues who I'll introduce in just a moment. But before I do, I'd just like to give a bit of overview and background as to why we felt today and the series of webinars was a really important thing to do, particularly in the current market. We're seeing a real increase in appetite from business owners looking to explore their options and understand how they might realise value from their business. Now, that's partly driven by potential concerns over tax changes and the budget, and I'm sure that will be a topic of discussion today, but also because there's a general sense of optimism that's coming through, particularly after the backdrop of the last 12, 24 months. On the buy side, we're also seeing increasing activity from trade buyers, both in the UK and internationally, who are reigniting some of their acquisition strategies. And that's really underpinned by a huge amounts of liquidity in both the private equity and debt markets to fund those sorts of transactions. But really, the first step in any business owner's journey in an exit is understanding what options are available to them and really which of those options best suits and meets their priorities and objectives, both at a personal and a business level. And quite often we find when we're discussing with business owners, if we can guide them through the process of what it might look like and what the destination might look like, they're much more informed when they come into a process and ideally much better prepared to maximise the chance of a successful outcome. So moving to my panel, if we could all introduce ourselves very briefly, if we start with Chris.
Yeah, hi Matt, hopefully you can hear me. So I'm Chris Bishop, I'm a director in the corporate finance team at PKF, and I've spent the last 10 years or so predominantly focused on providing lead advisory services on corporate sales. So that essentially means my day job's supporting clients who typically own and manage businesses or other SMEs looking to sell their business.
Thanks, Chris. Nicola?
Thanks, Matt. I'm Nicola Mann-Clark. I'm a tax partner here at PKF Francis Clark and specialise in transactions. I've been advising in transactions from both sell side and buy side for over 20 years now.
Thanks, Nicola. Tom?
Yeah, good afternoon. Tom Hicks in the M&A team here at Francis Clark, advising on a range of transactions across corporate sales and private equity, and more recently working with a number of businesses looking at how they can kind of optimize their data, both from a transactional and operational perspective.
Thanks, Tom. And last but not least, Carl.
Hello, my name is Carl Tremlin. I'm a chartered independent financial advisor working at Francis Clark Financial Planning. Into my second year with Francis Clark, but been doing the role for considerably more years than that. And I work in our wealth management service team, which has a focus on advising business owners pre and post exit. Thanks, Matt.
Thanks, Carl. So that's our panel. Before we get into the discussion, if there are any questions that the audience want to ask throughout, please pop them in the Q&A. We'll look to address those as we go, and if there's time and we haven't covered them, we'll try to cover them at the end. So kicking off, so we're talking about a trade sale here, and we call it a sale to a trade buyer, but back to basics, what do we mean by that, and why would someone embark on a trade sale? So just kicking off, Chris, do you want to go?
Yeah, sure. So I guess in answer to your question of sort of what do we mean by a trade buyer as such, so we're really talking about someone who's in the sector, in the trade, essentially, and therefore we're not talking about a buyer who's just making a sort of unconnected standalone financial investment. I suppose one of the key reasons that's an important differentiation is because I suppose the value of an acquisition to a buyer is really sort of generated by their ownership of the business's future cash flows, so the target's future cash flows. That's essentially what they're paying, what they're buying. And typically a trade buyer has got more options to maximize those future cash flows. So through synergies, so the whole sort of 2 + 2 = 5, and how do they realize those synergies? I mean, that might be sharing central costs after a deal. It might be cross-selling of products between existing company and the new company, increased buying power, or just other pure economies of scale, essentially. And because they can realize all of these potential upsides, they're typically able to justify paying more for a business. So value, I think, is the sort of key thing there. Is, if you're going to get maximum value, typically we see that coming from a trade buyer. And just because they can realize all these upsides post deal doesn't necessarily mean that they'll reflect all of that in their offer, but even some can make a difference. And whilst value is clearly a key objective of most sellers, it won't be the only one. And part of our sort of early stage job, which you touched on in your introduction, is really understanding what's important to a seller in terms of their objectives. So, for example, the seller might see that a trade buyer, as well as bringing a lot of value, might actually bring an element of professionalization, sophistication, and investment into a growing business that maybe has run its course in terms of a sort of ceiling with the existing owners and existing funding, for example. So it might drive opportunity, but I suppose we're considering the flip side. A buyer might have concerns. A seller might have concerns around factors like business legacy. So if it's bought by a trade buyer, will it lose its identity under that new ownership? Will there be potential culture clash? Sometimes people purely don't like selling to competitors in their trade. So conversely, there are reasons why some people might steer away from a trade buyer and perhaps. Despite it potentially being the most lucrative, they might sway towards some kind of internal transaction, such as an MBO, so settlement to the management team. But yeah, so that's probably a decent introduction of why people consider selling to a trade buyer and fundamentally what one is.
Yeah, it's probably fair to say that's the most common route we come across, and it's clearly maximising value out of a transaction tends to be the number one, but clearly that cultural fit with a buyer, what it's going to mean to the team and the legacy is going to be critical things to think about as well, as in addition to the headline price. So let's move into sort of planning for a trade buyer process. Now, clearly, once you launch a process and you go to market, there's a timeline to go through that. But this sort of early stage before you go to market, we're often asked, how long does that take? And sometimes it might be people are ready, they go to market immediately. Others could be years in the making, and it really depends upon where that business is and how prepared the team is as a whole. But just in terms of some of the details as to how a business can be prepared and some of the planning things that they might want to do both at a personal and a business level, perhaps we could sort of cover some of those. So who'd like to go first?
Do you want me to continue from a sort of plain corporate finance perspective, and then I'll probably hand over to Nicola and Carl for some of the other bits. So I guess sort of leading on from what I just said, that preparation phase is typically where we're really understanding what transaction is right. But let's say that we're considering going down a trade buyer route. This is where sort of giving you that a proper window of time is key, because if you decide to go down that route, there's things that you can think about that maybe what can I do in the months or maybe even years before a transaction that might make this business look more attractive to a potential trade buyer. So that might be business initiatives that we can push forward. We know there are certain players in our sector who we have a mind might want to buy us in a few years' time, and they're really interested in a key sector which we can progress. There's housekeeping things like if you're reliant on key contracts, for example, with key customers, are those contracts watertight? Are they up to scratch? And if not, can you do anything to improve them? And I think really this window, crucially gives you a bit of a window to identify any potential sort of skeletons and deal breakers. Mm-hmm. And I think it's probably fair to say that while some of the financial aspects can maybe impact value, It's probably some of the tax aspects and structuring aspects that can be really important and be potential deal breakers down the line. I think probably at that stage, I'll probably hand over to you, Nicola, to touch on some of the tax bits, if that's all right.
Thanks, Chris. Yeah, there are certain things which, if you think about at an early stage before really getting into any sale process, that if you think about and carry out, can be done much more tax efficiently if you do that early. So it's really worth thinking about planning ahead. Some typical things might be if you've got, say, some key management who you want to incentivize to help grow the business towards a sale, to help with that growth. Is there anything that you can do there to put in place some tax efficient incentives for them? Also thinking about the structure of the business and, for example, whether there are any assets within the business which the vendors or management team vendors might want to keep. Can you extract those prior to any sales? So quite typically what we might see is there might be some valuable property within the business which a buyer might not want to pay value for, and vendors might want to keep to as a source of future income. If you can do something to extract those properties at an early stage, that could often be achieved tax efficiently, as opposed to waiting to near the time of the sale. And also if there's any sort of planning which the vendors want to put into place in relation to succession planning, putting in place a trust or a family investment company, for example, thinking about that at an early stage is also really useful.
Thanks, Nicola. Just before we go on to Carl, I think that management incentivization's a really interesting one, and certainly when we're approaching a sales process for owner managed businesses, the second tier is a clear issue that often comes up. So I don't know whether Tom, you could sort of cover some of that around how an owner who is a manager, could also sort of prepare for their process with their team, etc.
Yeah, that's perfect. So I think often there's a kind of conflict here around people want to keep it kind of confidential for all the right reasons, but also bringing management in to support that process. I mean, if a management's looking to kind of, if an owner's looking to step back quite quickly, any acquirer is going to have to get some confidence that there is a management team in place that's going to continue to run this business day to day, taking into account all the synergies between the two. But I think, if you're running the business in the detail every day, these acquirers often haven't got people sat around doing very little to just drop into your business. So having that management team in play is crucial, and is generally often a bigger hurdle to get over, and often a blocker to a successful transaction.
Yeah, thanks, Simon. I think from our experience, we're often asked how long is a suitable transition period, and really there is no standard answer to that. I think maybe 6 to 12 months is fairly common, but it really depends upon the buyer. What ability do they have to take on the MD role or the FD role, whatever needs to be replaced. But the best advice we can give to any shareholder who's also a director running the business is to ensure that when they come up to the sale, if their objective is to walk away as soon as possible, is to make themselves effectively replaceable and make their role effectively redundant, which is often easier said than done. But the more you can do that, the quicker that transition post-sale can be. Okay, Carl, from a wealth management perspective.
Yes, I mean, the pre-exit period, it tends to be, from a financial planning perspective, a period which is often missed or ignored, but it's actually the period where the most opportunities lie. From a financial planning perspective, personal financial planning perspective, I would say there are 5 key considerations that one should note. The first one is to consider estate planning now. To piggyback on Nicola's comment, business relief is lost when there is a binding contract for sale. So considering your estate planning needs, what your longer term objectives are, and doing things like transferring shares into trust are an important consideration. Maximizing pension funding, like I say, it's a great way and remains a great way to extract profits from the business, cash from the business. Cash flow modeling. I think this is, again, something which tends to be missed. It humanizes the transaction. I think what it does, it allows you to consider the numbers and actually calculate with some efficiency what your standard of living will look like post-exit. And then it's to understand and consider the benefits that are lost. Obviously, one exits the business, things like life cover, perhaps private medical insurance, pension funding, these things are lost. And then finally, for those with a trading business, when there is a binding contract for sale, your inheritance tax liability effectively has gone through the roof potentially. That business relief is lost. So putting a temporary assurance in place can help protect that potential inheritance tax liability and allow you the time really to consider what your options are going forward. Over to you, Matt.
Thanks, Carl. I think it's probably fair to say that there's obviously a lot of attention on the budget that's coming up, and there is a lot of rumours around change that will potentially impact a number of these things. But as and when those changes are known, I think best advice is to take advice to see how that impacts your transaction and your personal side. So moving on past the planning stage, I wondered if we could talk about the sort of process as a whole. So perhaps do a bit of a walk through some of the key steps and what are the most important things business owners should be aware of ahead of going through a sales process. So Chris, you want to kick off with that?
Yeah, I'll kick off with this. So Matt said, let's say we've come through our planning phase, and we've hit all our business points, our tax points, our financial planning points, and we've decided to actually press the button on a sales process. What does that look like? Because there's a lot of people that only go through these once. So when we talk to clients, it's very typical for them not to really know what these look like at all, or indeed how much time they take, what sort of level of involvement is required from them. So let's just sort of walk through that. So first phase is really preparation. We've gone planning, we're now in preparation. So what does this involve? We're starting basically to pull together the information that we're going to be going to market with. And the key document within that sort of suite of information is what we call an information memorandum, or an IM. You can think of that essentially as a sales brochure for your business, if you will. So what's that going to set out? It's going to set out history, background, an overview of your products and services and other offerings, the nature of your customers, suppliers, and clearly financials, so P&L, balance sheet, and cash flow, both historical and forward-looking. But crucially, elements beyond the factual, if you want, like future opportunities for growth, information about where you think the market's growing, and what are we trying to pull out here? What we're really considering is like, what's the key buyer story that we're trying to get across? So thinking about who's going to be reading this, what are they going to be interested in, and basically what's going to make them inclined to want to buy this business and fundamentally pay the highest price. As with much of this process, this is collaborative really between us as advisors and the sellers. So part of the challenge for us isn't necessarily I suppose the drafting of the document, but it's really trying to pull out those valuable insights that quite often sit inside the heads of the sellers, and maybe either they take it for granted, or actually fundamentally most of our clients are modest people, and actually it's sometimes got a challenge to really think about almost going into sales mode. What do we do really well? What do we do better than others? And really highlighting those positives and those opportunities. That can be quite an interesting challenge. Also in this sort of information preparation stage, we're thinking about pulling together potentially financial projections, so putting together a financial model if clients don't have them, and we'll also draft up a what's called a teaser, so a one-page anonymous document with some very, very high level about the business, and that's what we use to initially approach buyers with to gauge interest, and that's all on a no names basis. So thinking about buyers then, so a key question is always like, how do we identify potential buyers? Again, collaborative with the sellers, but we're drawing on a range of sources to basically draft an initial buyers list. So that might be from our own knowledge of the M&A market, through the client's sector specific knowledge. You know, people typically have approaches, they see activity in their own market. Relevant databases, we also use sort of AI tools to identify potential interested buyers in the sector. We also engage with agencies who, I suppose you call them buy side agencies. So they work with maybe serial acquirers who are actively looking to find acquisition targets, as well as our own contacts across PKF. So PKF is an international network. Now that initial list tends to then get whittled down between us and clients, as to, you know, forming an A list of, I don't know, every process is different, but say 20 to 30 buyers. But crucially, we're not going to anyone on that list that our client isn't happy going to. And a potential buyer might look great on paper. They might have the funding behind them. It might be a good operational fit. Sometimes sellers just don't want to go to them. You know, there can be some deep-seated rivalries within the market, and you know, sometimes that can be a blocker, and that's fine. That's fine. And in terms of when we go to these buyers, I think maybe a common misconception that it's not like a blanket approach to market. You know, this opportunity isn't going on a sort of We Buy Any Business website or a Rightmove equivalent, although they do exist and they do have their place, and it's typically for smaller businesses. But you know, given the sensitivity and the wish to keep confidentiality to the maximum, our approach is always specifically targeted to those, you know, to those businesses that one of our clients is happy to go to, and also, you know, we work hard to try and target the specific individual within that entity. So we're not who's appropriate. So we're not going in at an operational level. We'll be going in at a senior management or a specific sort of M&A team level, which is crucial, and that actually can be quite a big challenge in terms of finding the right individuals, especially within some of those larger entities. But we have ways and means. I suppose, you know, when we talk about this sort of phase where we've approached the market, we mentioned it's no names basis. So we'll go with a teaser document. If people are interested, we'll get a non-disclosure agreement in place, and only then will we share this the information memorandum with them. And I'd say we're then entering a really, really crucial stage of the transaction, really. And this is the sort of, I don't know, say a month or so, 6 weeks maybe, of really engaging with these interested parties, perhaps answering limited questions they might have to supplement what information we've shared them, generally holding meetings either physically or typically virtually via Teams in this day and age, with the sellers and perhaps some key management, to really give the opportunity for a buyer to really understand more about that business. And the key point throughout this is that we make it clear to buyers that they're part of a competitive process. Why? Simply because that competitive tension is the best way of us being able to maximize the value of offers received. We can leverage that competitiveness to really push buyers. Buyers love doing processes off market. You know, same as buying a house, everyone likes to go and you know, just put a letter through the door and get a nice off-market transaction. But that's because people think that they can pay less, and that probably is true, because the minute you get into a competitive process, that's where you start being able to drive the offers up. So this whole phase is targeted really about driving a competitive process to obtain initial non-binding offers for the business. And at this stage, I think I'll probably hand over to Tom, if that's all right, Tom, just to talk about the sort of next steps onwards from initially receiving those offers, and what we do to negotiate those up, and then through diligence and end up driving to touch wood, successful completion. So I'll hand over to you, Tom.
Thanks, Chris. So once we've received those offers, they'll probably arrive in a variety of forms. So we need to pull out the key points from those offers to really understand them. So one of which is generally pretty key is the amount they're offering for the business. Now that headline number can often look quite attractive, but you need to dig into the detail to really understand it. So what are they proposing to acquire? Are they acquiring the shares, or are they acquiring the trade and assets of the business? And what form does that consideration take? How much of it is payable on day one? Is any of it subject to an earnout? So an earnout is when you receive consideration based on some future event. So that might be subject to future turnover or profitability or a range of matters. And some of that consideration can be deferred, which is similar to an earnout, but it's a case of sitting tight and just waiting for your money. So no future conditions attached. There's some other bits to kind of pick up on what to see in those offers, but I think at that stage it's probably Nicola to give a bit of insight into some tax pieces around those different forms of consideration and what you'd look out for at that point.
Yeah, thanks, Tom. So as part of evaluating any offers, and sellers will obviously be keen to understand what their total take will be, so what the tax consequences are of the consideration, and that will differ depending on the structure of the consideration. So for example, if you receive a deferred payment, that's usually subject to tax up front as part of the initial sale proceeds, but an earnout has a particular type of tax treatment and is a bit different. So it'll be important to evaluate those offers and to think about what tax is going to be payable and when. Subject, of course, to what changes in the budget, but as part of any process, you'll still want to understand what that final kind of amount that you receive will be. And the other thing is to think about as well whether there are any particular tax attributes within the business which you might want to get value for, and which you might want to include as part of any negotiations on the final price with the purchasers. So for example, typically that might be if you've got some options, so share options which could be exercised just before any sale, that often creates a corporation tax asset for which you might want to be specific about making sure that you get the value of that as part of the deal.
Thanks, Nicola. So there's a kind of few financial elements we'd look out for in that offer, but there's a range of non-financial matters you'd probably want to understand at this point as well. What's their commercial rationale for doing the transaction? What are they hoping to do with the business going forwards? What's your role going to be post-transaction? Do they want the sellers to remain for a long time, a period of time, not at all? How are they going to fund the deal? Are we comfortable that they've got appropriate funding and the approvals they require internally to actually transact? And what DD are they going to do? And we'll come on to DD in a second. DD being due diligence, so they're effectively inspecting the business before they acquire it. So there's a range of matters to kind of consider at this point, and then we'll start to negotiate those offers up, as Chris said. Now that might be trying to increase the overall value. It might be increasing the day one value. So there's a range of things you would discuss with the acquirer at this stage before reaching a preferred bidder, at which point you'd move forwards into drafting some heads of terms, which is essentially setting out the offer in a kind of more formal document, and also gives the opportunity to flesh out some of the detail which may not have been included in that original offer letter. And typically at this point, once agreed, you'll be granting exclusivity to that party, which effectively commits to moving forwards with that party and stopping all conversations with any other parties you were previously speaking to. Once you've got those heads of terms in place, we'll move into the due diligence phase. And this can take a range of forms. Typically, we'll see financial due diligence undertaken, which is a review of the company's financials and making sure effectively that the information we've provided with them to make their offer is true and stands up, and the business is performing as we said it is, and there's not any hidden liabilities or issues in the business. And typically alongside that financial due diligence, we'll see tax due diligence and legal due diligence performed. There are a range of other DD we can see being performed, such as commercial, not often in a trade sale, because often they're in the sector or in the market to understand that kind of commercial position. But occasionally you'll see cyber DD performed. Cyber a big risk to a lot of businesses now, so acquirers will want to get comfortable the business is safe from that perspective. And ESG, so environmental, social, governance. What's the business doing? Are there risks? Large businesses have to report on these things. So if they're acquiring a business which is doing things that aren't quite right or ethically don't look particularly sound or brilliant, they'll want to understand this before going into acquiring the shares of the business. So there is a range of due diligence that can be performed. And whilst DD is undergoing and post that process, we'll move into the legals, which is a longer process. You're talking a 100-page plus document here to transfer the shares of the business, and that'll include a range of things from price, structure, warranties, so promises about the business, and a huge range of matters. So I think the key point here is have a good corporate lawyer on your side to get through this process. Thanks,
Tom. We've had a question, so it's probably a good time to interject with that. So we haven't really talked about on how we value, or how a buyer may value a business in much detail. So the question we've had is, rather than having a multiple of EBIT, so we're talking about valuing the trade of the business by multiplying the profit by a multiple. So do companies ever have a sales price? So do you ever go to market with a price tag, essentially, a bit like selling a house? So Chris, do you want to take that one?
Yeah, no problem. The short answer is no. I'm not sure we ever do that, really. If you are on some of the sort of smaller sort of broker websites, almost all of those will have a price attached to them. When we go to market in a competitive process, we don't. Fundamentally, if the sellers want 10 million for a business and a buyer asks us and they say they want 10 million, surprise, surprise, the buyer's probably not going to offer 12. But we pride ourselves, I think, on overachieving for our clients, and driving competitive processes and finding those strategic buyers. So let's think about a buyer who looks at the business and goes, okay, on paper, yes, I think it could be worth 10, but from our own perspective, perhaps we've got operations in the rest of the UK and we've really struggled to get into this sector. For personally, we're happy to pay 15, 20. So we wouldn't want to put sort of an upper limit or too tight an expectation on the price. Now, when we're talking in early stages, is it typical for a potentially interested party to ask us what that sales price is? Yes, almost always, because why wouldn't you? But we're fairly reluctant to give them one. We typically just say that we're going out to a competitive process. We've got a lot of interest and the market will speak. So the short answer is no, we don't really.
That's Chris. And then just another question on sort of process. Now, obviously, we've talked about a competitive process where we're going to multiple parties. We're in control of that. And so, we know when people are going to be speaking to the buyers at a particular time. What about scenarios where, a seller might get approached by a particular buyer who may promise the earth, they may give them an offer? What should a shareholder think about when they get a direct approach like that? Tom?
Yeah, thanks, Matt. So I think there's a couple of points to pick up on here. be very careful with what information you share with that party very quickly. Often, you know, they might just ask for the last 3 years accounts. Now, does that really paint the picture of the business they're acquiring, and is that going to maximize the value for you as shareholders? So that's the kind of key point, is don't rush into sharing information, and be very careful with what you do share. And the second point is, you know, speak to somebody about that value. It might be that offer is crazy, and at that point it is the right thing to do to progress to that party and prepare some information in a structured way to share. But it might be that actually, you know, is it the right time for you to sell? If it is a competitive process the right way to go? Generally speaking, that is right. If you want to maximize the value for your business, getting a competitive process going is the right thing to do. So keeping that party warm is important, but don't feel the need to rush into satisfying them and giving them everything they ask for tomorrow, because if they really do want to acquire you, it's likely to be a big investment for them, and therefore, you know, they're not going to disappear if you don't answer the phone tomorrow and give them everything they need.
I think the key is keeping control of the process for as long as you can, because once you've agreed that heads of terms, once you've gone into exclusivity, essentially there is a bit of a power shift to the buyer, because at that point they will typically be doing their due diligence. And I guess just on that's a normal process where the buyer might do due diligence. In terms of vendor due diligence, which is a different option, Tom, do you want to cover how that may support a transaction and help, I guess, speed things along and perhaps maximize value?
Yeah. So like we said, typically or often, once you have granted exclusivity to a party, they will use their provider and do some due diligence on the business. And doing vendor due diligence, you'll still have an independent party, but they will prepare a due diligence report up front. So which will be provided to bidders. So you're effectively receiving post due diligence offers. Now, the benefit of that is speed. So you'll generally be able to transact a lot quicker because they don't have to do so much, if any. They'll likely top up the vendor due diligence, but it'll be a lot faster process at the back end as a result of that. But also you've had that independent kind of verification of what we've told them is true, and therefore there'll be less scope and less opportunity for them to chip the price later in the process. So when we spoke earlier about assessing offers, you know, if we've had vendor due diligence done, we can be, you know, hopefully very confident that the transaction will transact at the price and structure that was set out in that offer. So vendor due diligence does have a huge number of benefits for that reason. It does come at a cost, so that you know, you will often pay to have vendor due diligence done up front. Now, depending on how competitive the process is, we can often look to recover those costs as part of the offers down the process, because the acquirer won't be doing so much DD, but there is that upfront cost to performing VDD.
Yeah, I think it suits quality premium businesses where there's going to be a lot of competition, and you've got confidence that the buyers are going to want to engage in a process. But it's being on the buy side of a process where there's vendor due diligence is very difficult, because it just doesn't give them the scope to chip the price, as Tom said. So while we're on the subject of due diligence, is it worth just talking about some of the horror stories or some of the issues that we have seen, and perhaps we could have, or a business could have, dealt with prior to going to market, which probably would have helped the outcome. So, Nicola, do you want to cover some of those from a tax perspective, because they tend to be key ones that may derail a process?
Yeah, thanks, Matt. So the typical scenario we see, which can cause quite big problems in the sale process, is in relation to share rights. So where the rights attaching to the share capital are not quite implemented correctly from a legal perspective and don't reflect what the vendors intend. The problem being that potentially these sorts of issues can give rise to quite large PAYE and national insurance liabilities as part of the consideration on the sale. and so it can cause quite big difficulties. If those problems are uncovered at an early stage, like preferably before a sale process starts, then they can often be mitigated and managed. So if they can be spotted at an early stage, then that's really beneficial. So that's certainly something where vendor due diligence from a tax point of view is really worth paying for.
And from a M&A side, Chris?
I was just struggling to bring myself off mute. Yeah, I mean varied. I think it's probably fair to say that ones that are potential deal breakers tend to be tax driven, but there's a whole myriad of things from a financial point of view. So it may be just as an example that within your business there are maybe liabilities that exist or may crystallize around a sale that aren't necessarily reflected in your historical financial statements, so that actually later down the line this comes out in diligence, whether that's I don't know, an ongoing legal claim, for example, that there's no reflection of in your numbers, but actually when you get to the latter stages of a process, a buyer's going to want full protection against those. And you might say as a buyer, well, that's not our problem. As a seller, you say, well, actually that's a reasonable view, but often it's just aligning a seller's expectations. So if there are potential issues like that in the business, you should fully expect for a buyer to be protected against issues like these. I think also one of the things that's really important to understand, and this is not necessarily a vendor diligence point, it's a financial diligence point, full stop, and something that we really get into when we're drafting the information memorandum as well, is this the concept of underlying earnings. Now, the question we got asked around offers being based on a multiple of EBIT. So EBIT's essentially a profitability measure. There's a lot of work that goes into really understanding what EBIT actually is. Have you had a poor year because of some drastic things that have happened in the market and that aren't really reflective? Conversely, have you had a bumper year? I think back to sort of post-COVID bounce that some businesses obtained, and could go into a transaction based on making a couple of £1 million, but actually in diligence you uncover it and you go, well, they've made maybe half that every year apart from this one year, and you can pin it down to a couple of specific contracts that have ended. So like I say, whilst most of the sort of deal breakers are maybe tax, you'd really want to be comfortable that the sort of key metrics that you're going to the market with, i.e. how much profit you're actually making, which is ultimately going to be the basis of any valuation, really stacks up.
Yeah, thanks, Chris. And I think just adding to that, probably one of the biggest other areas where we see either deal breakers or price chips is performance between agreeing heads of terms and completion, because clearly the owners of the business are potentially running the business at the same time going through this process, and it's a huge strain on them in terms of their time, and there is a risk that their eye gets taken off the ball for the performance of the business. And so if that drops, that's where a buyer can come in and look at price chips. But I think more generally, if an issue is found, the buyer's got one of probably three remedies. It's either going to be they change the price, they walk away, or they seek some form of protection in the legal documents, and that effectively increases the seller's risk that there may be a way in which the buyer can come after them post-sale. So we do see or are seeing an increase in warranty and indemnity insurance. So that's an insurance package that shareholders can take to reduce some of their risk when it comes to warranty claims after the event. So just sort of rounding off the diligence process and perhaps some of the information that the buyers will want to see. We're seeing quite a bit of increase in the use of data analytics, and how, both in terms of how businesses can operate more effectively and promote their buy-side story before they go to market, as well as addressing some detailed questions around their own data during the process. So Tom, do you want to briefly cover that?
Yeah, thanks, Matt. So like Matt said, we're seeing, I think with the economic and political environment, some pretty detailed DD being performed, which leads to the business having to have quite sophisticated reporting if they're going to satisfy the buyer for this. So this might be looking at customer trends or product trends and really trying to understand where does the business really make its money. Do they have kind of products which break even and some which have superb margins, or how does a customer behave over 2, 3, 4, 5 years? What's the acquisition cost of those customers? Some pretty detailed questions. Now, I think it's not uncommon for a lot of businesses to not track this information on its kind of MI on a monthly basis, albeit it is incredibly valuable because it enables you to make some really informed decision making, which will have a good impact on your profitability, regardless of whether you're looking to go through a transaction or not. And the beauty of data analytics is, and the platforms we're kind of building for clients, is that it is live information. So that might be plugged into your website or your stock system or whatever it is, but you can see now what's happening in the business, which, like I said before, just allows you to make some really informed decisions on where you're taking the business. And I think the other benefit of data analytics is it provides huge operational efficiencies in the business, just because of that automation. So a client we worked with recently who actually went through a transaction and implemented this during that, they think the platform takes about 40 hours a week out of their accounts team, which is obviously it is huge. But from a transactional perspective, it can really help identify value drivers. If we think about who the acquirers might be, being able to point them to the right information to really see the value in the business is great, and will help maximize value for shareholders, as well as looking at where is the value leakage and what can we do about that before going to market. So I think the overall benefits of it are the operational efficiencies it can bring, and also that real-time live reporting to enable you to make pretty quick decisions in the business.
Thanks, Tom. That's useful. So I think now moving past due diligence and I guess information towards perhaps some of the non-financial areas, and in particular, quite often we get asked questions around, well, we're going through this process. When do we tell the staff? When do we tell the management team? Because clearly, uncertainty around a transaction is not always a good thing for businesses. So, how do we manage that, or how should a shareholder consider managing that, Chris?
Yeah, thanks, Matt. I think let's maybe assess this in two chunks, because we've mentioned a few times around strain on sellers' time, and actually sometimes there is a requirement for sellers to bring people into a process. I think generally we say sort of keep the people in the know, keep the circle of trust as small as possible. That's generally what sellers are comfortable with. I mean, it reduces the sort of risk and burden of sort of confidentiality. But as you say, Matt, purely the concept of a transaction and a change in ownership can be an unsettling one for the business. So sort of restricting that as much as possible, I think, is generally a good foundation. But sometimes you have to bring people in. So that might be because you need the support. Let's use an example. So the shareholders are up to speed in terms of history and operational, and can answer a load of questions in the diligence, but they're not the financial director, financial controller, and actually in diligence you need to bring them in. And the other time you might need to bring people in as well is if buyers actually think that that there are members of key management that they really need to meet, because actually they're coming in and they're investing in that management team and not you as a shareholder. So it is pretty typical to have that scenario. I think the overarching message there is do it in a controlled manner, and keep it to a minimum. And if, for example, we're talking about those management meetings, let's do it at a later stage in the process where fundamentally we're quite comfortable with some of the other elements of the transaction and we think there's a good chance of it completing, rather than introducing people into a process that, you know, then might not go anywhere, and you've got that sort of lasting maybe legacy of, oh, the sellers are trying to get out of the business and what's going to happen to us. But with all of that, you know, we mentioned things like management incentivization, so you can bring people into the process on the knowledge that it's a confidential process. You may have management incentive schemes in place. It might be as simple as doing completion bonuses to get people's buy-in into a process. Yeah, bear in mind that if you've got a financial director, they're probably quite busy, and actually, you know, now in asking for their help in the diligence process is going to be a fair amount of workload for them as well. So that's the sort of management sort of involvement piece. I think generally in terms of the wider staff, I think it's the normal approach is to only tell the wider staff after a transaction has happened. Again, you know, you might be 90% of the way there, but until it's signed on the dotted line, it hasn't happened. And you probably don't want to be releasing that message out to the staff before you're confident that it actually has happened. And typically that process of communication is something that a buyer is going to be very interested in getting involved with, because if you're walking out the door as a seller, you know, the buyer is completely reliant on your staff post-transaction. So they're really, really going to be on board in making sure that that's well managed, that the deal's positioned in a positive light. They'll probably want to be there and just reassure the staff that, you know, it's a staff is a buyer and the seller's, you know, key, almost number one concern post-transaction. So yeah, that's typically after it's happened, I think, Matt.
I think what Chris said there is absolutely critical, having a joined up communication plan post-deal, because I've certainly seen situations where that hasn't happened and staff have found out that the business has been sold before they've been told about it in the market. So you certainly want to avoid that. So I think in terms of our final area really is the deal's been done. Hopefully there's a large amount of cash that's come into shareholders' bank account. Now what do we do, Carl?
I think the key message is not to risk, Matt, and not to rush, Matt. It's to take your time, properly explore what you want to do post-exit, what your family wants to do post-exit. It's to allow your financial planner the time to understand these objectives. And like I say, it's to not act with pace, because if you do, mistakes tend to happen. When I speak to clients and with years of experience, I tend to see that clients have got three key objectives. One, two, or three key objectives. The first one being to maintain their standard of living for the rest of their lives. Two is to ensure that their wealth is intergenerational. And the one that's becoming more and more prevalent is the one that is to ensure that their wealth doesn't corrupt the next generation. So it's a minefield. There's an awful lot to consider. There's the management of cash, the management of investment portfolio, so that risk management piece. So I think the key message is to not rush, properly engage with your financial planner, allow them the time to properly understand you and your family, to understand your needs, your objectives, and what you're looking to achieve, and then take the time to together build a plan which is both tax efficient and meets the objectives that have been set. And then the final piece of that jigsaw is just to make sure that you review. There are these events, and I think the 30th of October is perhaps the biggest one on everybody's mind. That rules, regulations, goals, etc., they continue to change. So just maintain that relationship with your financial planner and make sure they're continuing to update everything that's in place for you to achieve those goals. Thanks, Carl. Well, I think that brings our discussion to an end. So I think just wrapping up on some of those key points, really. I don't think we can emphasize enough the importance of preparation and how a business is positioned when it goes to market. Really look at it from a buyer's perspective. What is it that they're going to value?
and what are the things you need to put in place and grow those opportunities before you go to market, perhaps passing on some of your responsibilities to other management. I think looking at some of those deal breakers, some of those things that will either lead to a price chip or perhaps the deal falling away altogether, really getting underneath that, whether that means doing formal vendor due diligence or doing a dummy due diligence process. I think that's critically important, especially given the current market where buyers are being very cautious about what they're investing in. I think the tax legislation that underpins the after-tax proceeds is always something that you need to take advice on. It's incredibly complicated, and there's often things that you can do ahead of a sale, and certainly we'll see what happens at the end of October to see what steps can be taken after that. And then finally, I think from a personal perspective, as Carl sort of highlighted, not to rush, really understand those personal objectives and making sure that they're properly considered when you're looking at wealth planning for you and your family. So finally, I just want to make a final plug for the two other webinars that we've got coming up. So in 2 weeks' time, on the 3rd of October, we've got our management buyout and employee ownership trusts. And on the 17th of October, we've got our selling to private equity. So thanks again for everyone that's listened in. Hope you'll enjoy the rest of your days. So thanks all.